The government accuses Wall Street's Goldman Sachs with defrauding investors in the days leading to the economic meltdown. In a civil complaint, the Securities and Exchange Commission says Goldman failed to disclose conflicts of interest in complex mortgage investments just as the housing market was spiraling downward. Goldman Sachs is charged with failing to disclose that one of its clients helped create and then bet against securities tied to subprime mortgages that Goldman then sold to investors. The Goldman client implicated in the alleged fraud is one of the world's largest hedge funds, Paulson & Company.
Investors in the CDO lost approximately $1 billion, and Paulson's CDS positions yielded a profit in approximately the same amount.
Wall Street recoiled at the news, with stocks initially falling sharply. Veteran Wall Street hand, Art Hogan, says the problem is trying to figure out how much wrongdoing really took place.
Well, it's hard to say. You know, it's interesting and it's impossible to know what the SEC has in terms of other cases. This is the first one that this division of the SEC has put together. So, you know, obviously there's going to be some fear that there might be a backlog of other cases that are out there, and we won't know that until we do. I think there's more a fear that in terms of market reaction.
For its part, Goldman Sachs vows a fight. In a statement, it called the SEC charges completely unfounded in law and fact and said it will contest them. The agency also charged a Goldman vice president whom it said was principally responsible for devising the deal and marketing the securities. In its conference call with investors, the SEC says it continues to investigate a broad range of practices. The civil suit comes as members of Congress look to crack down on practices blamed for setting off the crisis. That includes toughening rules for complex investments like those involved in the alleged Goldman fraud. Mark Hamrick, The Associated Press, Washington.